What's up, everyone? I'm Nick Campo. This is
Big Boss Ben.
Big Boss Ben, and we are the Loan Guys, brought to you by NBI Financial Group right here in the Campo Media Group studios. What's up, Ben?
Just another day.
You want to know what I want to do?
What?
Right before we get started?
What?
If you don't follow us yet, please go to all of our social media pages. We are NBI Financial Group on everything. That is Facebook, Twitter, Instagram, TikTok, which is YouTube, TikTok, which is blowing up, Rumble, which is coming live to you next week. Well, not live on Rumble, but Rumble will be live next week. I'm the czar, C-Z-A-R, czar of mortgage on all of my personal. What is your personal?
Big Boss Ben.
Big Boss Ben. Follow us. We are some great personalities. At least I am.
Well, that's debatable.
What do we got today?
Depends on who you ask.
Right.
So it's been a pretty big start to the new year in the housing industry. A lot of changes here. We're going to start off actually by going over some numbers in the building community.
So builders, like building houses.
New homes that are being built.
New homes that are being built. I just did a TikTok on new homes that are being built.
Interesting. What'd you talk about?
Single family rentals and build for rent. But
that's going to be huge this year.
It's good. We'll get into it. But
right.
What were you reading about?
Right. So, I mean, as everyone knows, so new built homes has a much longer turn time, right? It's not just a normal purchase home because you're looking at 9-12 months out. So they're usually a little ahead in terms of what they are preparing for the market. So it's kind of interesting to look at it in terms of what are they seeing, what are they preparing for over the next 12 months.
What do you mean they're a little bit ahead? They're predicting a little bit ahead?
Absolutely,
Gotcha.
because they need to be prepared for what's coming. They need to be staffed up for it.
Right.
So we're looking here at the job openings in the construction industry.
Are there jobs in construction?
There are.
So all the people saying there's no jobs out there, there are jobs.
Oh, there's jobs.
You just
out
have
there.
to want to do those jobs.
Right.
Gotcha. Okay. I always get confused on that part.
Right.
People are saying there's no jobs, but literally whenever I wanted to find a job, I could find a job. It's whether or not that's the job I wanted.
Yeah.
Weird.
Yeah. So, I mean, and just looking at it from the number standpoint too, because as of recording just a few days ago, the most recent builder confidence numbers came out, which is people in the housing industry, how confident are they in the current building market? And it came out, it increased for the first time in 12 months, up to 35%, which is still historically low. But it's increasing. It's improving. We're moving in the right direction.
It went up to 35%.
It did.
Builder confidence.
Right.
Which is still considered negative because it's below 50%.
Exactly. Anything over 50% is considered negative.
Below 50%, not over.
Below 50, correct. Back in 2020, I mean, we were around like 80% confidence rating.
Why wouldn't they be confident?
Just because of, in terms of, I mean, it's still from like, they're still having issues with supply chain. The higher interest rates are impacting builders because those are higher cost jobs to begin with. And it is, I mean, it's been hard times right now for builders. I mean, 29% of builders have cut housing prices. You go around, look at all these national builders, they're dropping their prices. They historically have not given great commission to buyers agents, realtor agents. They're now offering a lot more on that to try to incentivize realtors to bring potential clients to show their homes. They're just doing a lot more right now that they have not done historically. However, like I said, it looks like it's starting to change just with the confidence rating going up, the fact that they are now hiring. I mean, 5.5% is the highest job opening in the construction industry in the last 20 years. It's at 4.8% right now. So it's
close to the highest ever.
Exactly.
It's up there historical highs.
Exactly. So what do you think that means for going forward?
I hate builders.
Yeah.
I mean, I do not like dealing with builders. I shouldn't say and when I say builders, I'm thinking of Lennar and the big national builders. Now, there's some local, 75 to 100 units a year type builders.
Right.
I love working with them. But the builders who have their own lenders in-house, right, can't stand them because it's cheating. It should be a conflict of interest. It takes competition out, and they sell the buyer on doing it all right here for them, with them, I should say.
Right.
And they make it seem like it's a better deal for the buyer or our client, and it's typically not a better deal.
Right.
As far as them having to actually give realtors commission, good. I'm glad they've had to do that. As far as them having to give more incentive, good. I'm glad they've had to do that. There's massive profits built into those homes.
Yeah.
And a lot of the homes aren't built well, right?
Quickly and cheaply.
Quickly and cheaply. They're throwing them up. But they are meeting a big time demand in the market. We still do not have enough homes on the market.
No, not even close.
So my thoughts are this: keep building. We need to flood the home with, the market with homes. We aren't close enough to the inventory that is needed for our population, especially with startups, first time home buyers, household formations, and things of that nature.
Right.
What I was looking for there was first time household formations. Right. We do not have enough homes.
I don't think people understand just how low the inventory out there is and how
it's
badly
extremely low.
We need new homes to be built.
Terribly. We need new homes to be built. We need new homes on the market. Terribly need it. Here's the other thing that they don't understand is interest rates went up, but they were still below the 30-year average, right? So they were high, and they were high for our lifetime. Like, if you think about it, I'm 33. The last time interest rates were this high was what? When I was 3 years old?
Yeah.
You know what I mean?
Oh, yeah.
So they're extremely high for our lifetime. However, they have come down big time since December 1st. We're locking people in at 5.5%, depending on like credit scores and things of that nature.
We
right?
are.
So my thoughts when it has to do with this market, when it has to do with 2023, when it has to do with housing in general, is buy more homes if you can. Don't over leverage yourself. If you aren't in a primary residence, get into it now. Right. I don't think you should wait. Don't wait for interest rates to come down. Get into it now.
Right. And
you had a thought, I could tell.
I did. And it was kind of going off of what you mentioned earlier about buying homes, buying investment properties. Now's the time to expand if you can. It is a little tougher times, but if you can, now is the time to get in there. You mentioned build to rent earlier.
Well, I want to finish my other thought first because I'm getting to that.
Okay.
I don't know if you saw my TikTok this week. It was all about the build for rent market. It was an article. I did an article that was published in January 9th. And if you don't follow me on TikTok, it's NBI Financial Group's page is where I'm posting it. I will be Czar of Mortgage on there. I haven't gotten that rolling yet, but I own the page. But what I am getting at is I'm telling people to buy now.
Yeah.
But Nick, the interest rates, I'm going to be paying $200 higher than I would have. Buy now.
Right.
Buy now. The interest rates are going to come down at some point.
Oh, yeah.
Are they going to be historic lows like 2020? Absolutely not. But are we going to be able to lower that payment? Yep, we will. You know what I'm not going to be able to do? Build you a new house from scratch to meet the inventory issue. People keep saying to me, why? I have one guy telling me, oh, you're just trying to hustle before this other shoe drops. There isn't another shoe, my man. There's no other shoe. The other shoe is not going to drop because there is not one. Right? What they're talking about is when they say this guy was saying the other shoe is going to drop, what I assume he was talking about is a 2008-like crisis. There's not going to be a 2008-like crisis. In 2008, inventory flooded the market. We had too much inventory and not enough demand. And when there's too much supply and not enough demand, prices drop. But what they failed to tell you, Ben, you know what they failed to tell you? They failed to tell you that in 2008, 2009, when the housing market crashed and real estate crashed 40%, 35%, guess how long it took to recover the loss?
Oh, years.
3 years.
Yeah.
That's not bad.
No.
You say, oh, years. Dude, if you have an asset and it drops for 3 years and it comes back up, and it's worth more than what it was when you previously bought it and you're in the green, I'll take that 10 out of 10 times. 10 out of 10 times. As long as you don't sell, you don't lose money.
Okay, but what I was getting at when I said it like that, because that is a long time for real estate. Because historically, it does not, very few times does it even drop. And if it does, not very much, and it's right back up the next year.
That's what you were getting at. So
right, that's what I'm saying. So like that 3 years is historically that is a long time.
But 3 years is not a long time. I understand what you're saying, but you're saying it in a very negative fashion. You have No, you do. You have a sense
negative.
Yes, you do.
Fact that housing's a safe investment.
It's not what you're saying. It's how you're saying it. You're saying it, it's a safe investment, but it took years. If someone hears it takes years, they get scared, man. It's how you frame everything, right? 3 years is not a long time. Plain and simple. You and I talk about this all the time. You frame things and you make things sound like it's a bad thing when it's not a bad thing. What I am saying is if you got into a house and the market dropped by 35% and then 3 years later the market was up by 40%, you're up 5%. That doesn't happen in other investments like that.
Right.
Only in housing does that happen, and historically housing goes up. There are dips and trends here and there, but the way you said that is framing it in a negative light when it's actually a positive thing. Would you agree?
No, because that was the worst in history. Like, that's as bad as it's going to get. And
you said years.
Only 3 years.
Years sounds scary to people.
Okay.
No, it is. It sounds scary. And I think it's good that we're having this conversation on the podcast, because you can see the difference in the way I think and the way you think, right? We're thinking the same thing, but you don't know how to express it so that people are comfortable with it. You should be comfortable with the fact of knowing that in history, one of the worst housing crises in history,
right,
outside of probably the Great Depression, one of the worst crashes in history.
Yes.
It only took 3 years to regain value, and it was up.
Yes.
After the crash. That is holy crap good.
Yeah. That's what I was getting at.
I understand that, but the way you said it comes off as negative. I know that's not what you meant.
No. That's definitely, yeah.
But you have to understand that the way you speak to people and what people hear, it's not what you're saying, it's how you say it. So what I'm telling people is, hey, this is the best time to buy right now when interest rates are up. You want to know why?
Because guess what happens when they come down?
Mass appreciation.
Absolutely.
But what else? You can like I can get seller credits right now that I couldn't get 2 years ago. I can negotiate prices down if I want to. I can negotiate home warranties. I can actually get an inspection. I don't have to waive my rights to appraisals. I can make things contingent on appraisal again, right? Couldn't do that 3 years ago, 2 years ago, I should say. Now you can. And guess what's going to happen? May 10th, mark my words. I've been right, and you know I've been right. Pretty much spot on when it comes to rates and it comes to what rates are going to do. I said, and inflation, right? I said inflation was going to peak, correct?
Yes.
In what? October or November?
You did.
October 28th was peak inflation.
Yeah.
So I was right there, like basically dead on. Late October or November. And it peaked, right?
Yep.
So now I'm telling you that rates are going to start to fall on May 10th, and we are going to be in a very good position as far as interest rates are concerned and as far as a refinance market for mortgage people, but it's going to be a tougher position for you to buy a home.
Right now, yes, because of affordability, because it is a higher payment.
No, not right now is not a hard time to buy a home. See, this is what we're getting at. Right now is a great time. It's easier.
It's an awesome time to buy a home.
It's the easiest time to buy a home. It's not hard. It's easier than it was a year and a half ago. There's not going to be multiple offers.
So you're talking about not from a affordability standpoint. You're talking about just from a market and how much.
I don't think it's harder from an affordability standpoint either.
I mean, there's a ton of programs that are beneficial.
Forget the programs. What can you get right now?
Seller credits.
Seller credits. So you can do what? Buy the interest rate down, even permanently. If we're locking you at a 5.5%, 5.65%, I can lock you permanently with a seller credit and an interest rate buy down at 4.65 or 4.5%, somewhere in that range, right? Do you know what my home that I bought last March, what the interest rate was? 4.375. And that was before rates started going up.
So you think in 6 months it's going to be, it's not going to be easier to buy a home, to get qualified?
It's going to be hard. I'm not talking about qualification.
Okay. You're talking about in terms of actually finding a home and getting your offer accepted.
Yeah. And I think that how hard it is as far as qualification and affordability, I think it's going to be the same. I think that right now I can pre-approve somebody at a 4.625 pending a $10,000 seller credit to permanently buy the rate down. I think that in 6 months to 8 months, we'll be around the 4.85, maybe 4.5, 4.85 to low, like 5, because we're at 5.5 now, and I think it's going to continue to come down.
4.5 to 5, I agree.
And it's going to continue to come down. I think that affordability is the same now as it's going to be in 8 months if you're working with someone who knows what they're doing. I literally have a text on my phone right now with a realtor saying, we have to have $10,000 seller credit.
Yeah.
There's houses on the market. There's inventory on the market for the first time in forever. And we're in the hottest purchase market. Zillow just voted Charlotte the hottest purchase market in the country.
Yep.
And there's inventory there to where you can negotiate not only down in price, but you can negotiate seller credit.
Yes.
So if you're getting $10K in seller credit, you're buying down over a point, right?
Right.
So if you're buying down over a point, we're where we're going to be in 8 months anyway. So how is affordability and qualification harder now than it is in 8 months? Serious question.
Because you're still going to be able to get some seller credits in 8 months, I believe, too.
No, you're not. You're dead wrong. That speaks of somebody who doesn't work in the market enough and understand how much our inventory is lacking. And I'm speaking more specifically to areas of big growth like the Charlotte, the Texases, the Floridas, the areas that are growing more so than other states. I'm speaking specifically to regionalize in our area 6 to 8 months from now. I don't think seller credits are going to be a thing, and I think 1 to 2 to 3 offers is going to be a thing on every single house. I think that I truly believe that. You don't?
I think we'll still have some seller credits because I think the appraisal value is going to be there. I think it's going to be higher pricing. I think the price is going to skyrocket because I think people are going to put offers
you think
over asking price
okay.
with credits. Because right now, everyone's seeing the benefit of seller credits. Between that, temporary buy downs, do you think those are going away?
Yeah.
You do?
Seller paid, yep. Which is why UWM already started shifting and other big places already started shifting to where you can buy out the LLPA, which is essentially what they're doing. You're buying out the loan level pricing adjustment to get your interest rate down for a year. They're allowing the buyer to start to pay for that. So, yeah, I do. I think it's going away. I think you have to read the market. Appraisals don't come up as fast as you would think they come up either. There's a little bit of a lag time. There's a little bit of lag time with the quote-unquote decreasing of appraisal or not appraising at value. So there's a lag time. I am telling you right now, on every purchase we have come in, do we not have seller credits?
We do.
That will not happen 6 to 8 months from now. It's just not going to. You're not going to be able to get the same deal with multiple offers. You just can't. It's more competitive. And you're going to have to waive appraisal contingencies and things of that nature. So my whole point of what I'm saying to we disagree on this, and that's fine. I'm better at mortgage than you. What are you going to do?
We're talking about 8 months. We'll see in 8 months, but
we will. Have I been wrong yet?
You've been wrong on some things. You've been right on a lot of things.
What have I been wrong on? Can't say that without bringing it to me. It's like church, man. If you have a problem with somebody, you bring it to them. If you can't get the problem resolved, you bring it to the community or to the church.
You're saying you have never been wrong on anything.
In my life? I'm talking about mortgage since we've started this business and my predictions. What have I been wrong on?
The big predictions you haven't been.
What's the little prediction? You can't name a single little prediction I've been wrong on. So you said I haven't been wrong on the big prediction. Huh?
I'd have to go back and look at them.
Go. Listen, that's your challenge for next week. Go rewatch all the podcasts. Okay. Find out what I've been wrong on. I don't think I've been wrong. I don't speak in terms of absolutism. Like this is absolutely going to happen.
Oh, yeah. No.
But I will tell you this.
Neither of us do.
You're wrong when it comes to seller credits being what they are today. You're dead wrong. And you're wrong when it comes to affordability. It's all how you look at it. You're a very negative person. So any type of thing that could cause friction, you look at in a negative light when it shouldn't. Not a negative person. I'm not saying it as
I don't think that's negativity. I think it's because I'm looking at being more positive in 8 months as well.
How?
Because I think it's going to be a lower base rate, plus you're going to have the seller credits. You're going to be able to get because I think that's going to be a great time to get into permanent buy downs.
I don't think you're going to have it.
Okay.
You think the Charlotte market's going to have that? The Raleigh market's going to have that? You
Charlotte,
think
Raleigh
Charleston?
market, or I don't know.
What about Charleston? Anywhere that we do business, do you think they're going to have permanent? You don't think there's going to be massive explosion of people still trying to move here?
Yeah, it probably will be in this market.
Okay, so who are you talking about?
So,
who are you talking about though? Then what market are we talking? Are you talking about upstate New York where there's no jobs and everyone's leaving?
No, I mean overall, there's a lot of places that are going to be able to have that.
I don't think so.
I mean,
but we can move on. I was talking a little bit more. So I was talking. Finish your thought. Go ahead.
Nothing. I've already said what I needed to. I think it's a tool.
You disagree with me?
Yes.
Okay, that's fine.
Because I think it has benefited sellers in this market, and I think realtors are seeing that.
You think that seller credits have benefited the seller?
Yes, I do. I mean, at the end of the day,
you're 100% wrong. How can you say that?
Because it allows them to have because it increases the amount of clients that can qualify. That it helps the clients with affordability, increases their own buyer pool.
They lose money off of it. This is not a seller's market as it stands.
No,
they're giving away money. I don't think it's benefited them.
See, I don't think it's that much of as buyer's market as you think it is. Then, I think this is
every home that comes in under contract has seller credits. That's a buyer's market.
But what average 16? We're at 16 days average listing.
It's over 20
contract. Now. Okay, but what is a healthy average?
Healthy's market 35.
35.
Okay,
so we're still under that.
Okay, what's your point?
The fact is that there are still buyers out there. And yet they're still giving seller credits because it's beneficial. It increases the buyer pool, and they have found that out.
The buyer pool is going to naturally double or triple once interest rates come back down. Seller credits aren't happening. Why would you give a seller credit if you have two other offers that aren't asking for seller credit? One of those offers,
because I think it's going to be showing the purchase in the value of the home.
One of those offers is going to be over asking price with seller credit. Another one of those offers is going to just be over asking price, and another one's going to be at asking price. You're taking the one that's over. You're taking what's best for your bottom line.
You are.
But we'll check again in 8 months. That's a good thing, a good poll we can do. Do you think in 6 to 8 months when seller credits come down, or do you think in 6 to 8 months when interest rates come down, will seller credits still be readily available?
Yeah. That's a good question.
That's a poll question. If you do not follow us on social media, please do us a favor. On YouTube, go ahead and bang that red subscribe button and turn on the notifications. We appreciate everyone that follows us. If you subscribe to this channel and you comment with your Instagram handle in the comment section of this video, you have a shot to win a $100 Amazon gift card that we are giving away on January 31st. So please be sure to bang that red subscribe button and turn on the notifications. Also, if you don't follow us on social media, we are NBI Financial Group on all of it. That is Twitter, Facebook, Instagram, Rumble, YouTube, TikTok. I'm the Czar of Mortgage personally. This is
Big Boss Ben.
Big Boss Ben. Hey, what else are we going to talk about? One of the things I wanted to touch on that we haven't touched on yet is build for rent.
Yes.
And single family rentals.
Yes.
So there was an article on Housing Wire the other day. Build for rent, single family rentals. Places like J.P. Morgan Chase are getting involved. You got BlackRock, multi-billion-dollar companies. There was a couple other multi-billion-dollar companies. Another company raised $1 billion to get involved in this. Lennar Homes, a $1 billion corporation, also raised money and is partnering with a couple of real estate firms to get more into the single family rental build for rent. And one of the things that they're doing is they're targeting millennials.
Yep.
Right. And then they're going after, and they're putting in amenities like like weight rooms, workout areas, swimming pools, like stuff that apartment buildings would have because the quote unquote millennials are used to this. And we want to provide a place like they like for them to raise their family.
Right.
What are your thoughts?
I mean, I think it's very interesting. And I mentioned earlier about builders and things like that, giving more incentives. And I think this is one of them because they used to have requirements on how many could be non-owner occupied.
Right.
They are lowering that number. You mentioned Lennar specifically was in that. I mean, but a lot of builders are doing that because it is going to be such a big market because a lot of people are seeing the advantages of that.
Of what?
Of
you say
rentals,
of that?
Of buying rentals, building rentals.
A lot of people are seeing that as far as the $1 billion corporation. You think that's a good thing?
No, not necessarily that they're doing it, but like the fact that the builders are doing it because the builders aren't necessarily going to rent it out themselves. They're going to sell it. There's people.
They're selling it to Blackstone, JP Morgan Chase, multi-billion-dollar investment companies.
They're selling to everyday people too, though, right?
They've set aside 38,000 units to sell to billion-dollar corporations.
That's concerning. I was thinking that a lot of people were selling it to actually people that were investing.
No.
Smaller investment companies to.
Nope.
Because I think that's a great thing.
Lennar's doing it. Lennar partnered with a real estate firm to have their own single-family rental and build for rent communities.
Okay.
Like they're building huge communities just to rent out. That doesn't concern you?
That does concern me.
Have you ever seen that World Economic Forum?
Because I'd seen a few articles on that, but it did not mention that. And I knew that Blackstone was doing. I mean, Blackstone's bought up half of Arizona by now.
I saw. Right, Blackstone pretty much owns Arizona.
They do. Like
they're making it so that you. This is that World Economic Forum thing where all the conspiracy theorists where they say you will own nothing, and a lot of people say, well, that's not really what they said. Well, that is literally what the commercial said, right? And
right.
Klaus Schwab himself did not say that. But what it said was you will own nothing. When you want something, you will rent it, and it will be delivered by drone. It was like their picture of the future. Here's the issue I have is the World Economic Forum and people like that, they're so out of touch with everyday working class Americans that they have no clue what we want. And homeownership is something that every working class, that is the American dream. Home ownership is the American dream, and it's how we get ahead in this nation. Plain and simple, right? And what's happening is when Blackstone's buying Arizona, when BlackRock is buying Arizona, basically all the houses in Arizona and Seattle, Washington, they did this as well. And then you have JP Morgan Chase getting involved. You have Lennar raising $1 billion, partnering with other billion-dollar real estate firms. And what they're doing is they're not selling it to you to rent out to somebody else, which that is what it is. Some people have to rent based on what their circumstances.
Right.
What they're doing is they're doing what the World Economic Forum said in that commercial, you will own nothing. Corporations are now going to own everything. So all the money is going to be transferred to the top, right?
Right.
So if you're a multi-billionaire and you want to siphon money, you go after the working class people and you make it very hard for them to own a home. And what will happen is that $22 a month, multiply that by 38,000 families are now paying you $2,200 a month in rent and getting nothing for it. There's no equity built. There's no appreciation that's going to them. The big multi-billion-dollar company is getting their equity and is getting the appreciation on that property. Meanwhile, they're targeting millennials, and especially millennials with a family. It is not good, millennials, if you are just renting. And then you see this other thing, and this was a Grant Cardone thing. Grant Cardone said you are stupid if you buy a house prior to being a millionaire, because it's taking X amount of dollars. Well, you're losing that money anyways by renting. And what the argument is you're paying more for a home than you would if you were renting. I call bullshit. Guess who else is starting to buy up a bunch of houses and dilapidated properties, rehabbing them, and then renting them out to you, the working class people. Guess who's doing it? Grant fucking Cardone. It's just a big ass scam by people with clout who have a lot of money to take money out of your pocket and flow it to the top, flow it to the billionaires. Is it smart? Hell yeah, it's smart. It's what we preach on a smaller scale, a comprehensive real estate plan. But ours is to help people build wealth through 6 to 12 units, where theirs is let's buy up everything and take the wealth from everybody in this country.
What other six-figure investment can you get into that is amortized over 30 years?
You can't.
There isn't one. That is why housing is the investment that will.
How do you stop it?
For the everyday man? Like, and the fact that someone says something like that is absolutely ridiculous.
Oh, the Cardone thing?
Yeah, that you have to have $1 million in the bank to buy a home.
What really pisses me off is that you have BlackRock, you have JP Morgan Chase, you have these other places going and buying up all these properties and then renting them to you. And how they're buying the properties, they aren't buying them at fair market value. That's a fucking problem too.
Right.
They're not buying them at fair market value. What they're doing is they're overbidding by 25 to 50% on the property. I was talking to my brother-in-law about how hard it was for him to buy his first home.
Yeah.
Every home that he went to buy outbid by 50%. And some of those homes were bought by corporations. Dude, like, you can't do this because of the way our economy is set up. And I don't know if you'd want to do this, but how do you stop that from happening? How do you stop BlackRock from buying 38,000 units? 38,000 houses. How do you stop it?
I mean, you can't.
You literally cannot stop it. Dude, we're talking about just, that's a lot of housing, right? And then we have an inventory issue, and then those companies are just looking at it as a bottom line. So some of those units might actually be sitting empty, but they're making, it's a portfolio to them. So they're making money on the portfolio, and they aren't maybe necessarily trying to get them rented out as quickly as possible.
It's a depreciation write-off for them.
Right. 100%, like 100%. And so what do we do to battle back against it? I mean, you have to educate people.
Exactly. First and foremost.
But at the same time, if you can't find a house to buy and you have a wife, you have a kid, maybe a second kid on the way, and you can't find a house to buy, but there's this really nice house over. This just happened to a friend. Couldn't buy a house, couldn't find a house to buy. We're in a hot market.
Yeah.
Is now renting a home for $2,200 a month, 3,000 square foot home. Dude, that's typically a house that would be for sale. Yeah. You know what I mean? So it just happened to a friend of mine and my wife's, and I'm happy that they got a nice home to live in, but part of it makes me sad knowing they'll never gain the appreciation over the next 12 months, and that's something you'll never get back. And to buy that same size home, it's going to be, people are saying 3% appreciation. Bullshit. It's going to be closer to 7 to 8% by December of 20.
Right.
Here's something that you can mark down, whether I'm right or wrong on. It'll be 7 to 8% by December of 2023. Appreciation over a 12-month period.
From beginning of the year to the end of the year?
Right. In our area. In Charlotte and North and South Carolina. So, yeah, it's just... it's something that scares me. It reminded me of the World Economic Forum when they put out that commercial, you'll own nothing, you'll be happy, you'll rent anything you need, it'll be delivered to you by drone. And then the question is, well, what if you don't return it on time? Does the drone shoot you? So,
yeah.
Oh, shoot. But yeah, that's that build to rent, single family rental. I think it's a great way to build wealth, but at the same time, how do you stop? You don't really want billion-dollar corporations doing it, but there's no way to stop them.
Right. I mean, there isn't. I mean, what can you do? I mean, it's a free market. They have every right to buy a home too, but
it's not that free.
Well, yeah, not after they own everything.
Well, not to mention they're the ones with the lobbyists that are putting everybody in Washington to stop basically competition.
And that's why I was excited. I thought it was a good thing when I saw about Lennar and them focusing more on build to rent, because I was thinking it was going to be an outlet for everyday people to buy rental properties and fight back against the big corporations.
They are a big corporation.
That Blackstone? Yeah.
So is Lennar.
Yes, but I thought they were going to sell them.
Lennar's creating their own branch of build for rent.
I thought they were going to sell them to smaller investment companies, rental companies. Like if we want to buy a rental company, we could.
You must have been very sheltered as a child. I mean, you have these rainbow and butterfly of the world in certain instances.
No, but
no, they're not doing that. Housing Wire had the article. You can go on our TikTok. I talk about the article and give the headline and the date that it was actually published. Lennar is creating their own arm of their business where they're building homes for rent.
Yeah.
So, oh man, it's exciting stuff in the homeownership world these days.
Yes, it is.
But you got anything you want to say to the people? Like, hey, follow our page.
Yeah, follow us. Leave a comment as well. Like we'd love to hear from you, especially leave your Instagram handle. That way you are eligible to win a $100 Amazon gift card. We're drawing it on end of January, right?
Right.
January 31st.
Yeah, January 31st, last day of January.
So don't miss out on $100.
So what he's trying to say is bang that red subscribe button and turn on the notifications. And if you don't follow us already, go to all our social media pages. We're NBI Financial Group on all of them.
Yes, we are. So we've already kind of touched on a lot of this, but in terms of like the current housing market and inflation numbers, because you've mentioned that it peaked October, was it 25th?
8th, I think.
28th that it peaked. So, and you've said this before, and it's true. Like, so it's a 12-year moving average.
Yes.
About it, because, and this is what I think a lot of people miss when they think of inflation. They're
12-month moving average.
Correct.
Yeah. You said year, but it's fine.
Sorry, 12-month moving average. Because what a lot of people don't think about is the shelter inflation.
Right.
Right. In terms of
it lags.
Exactly. So even the inflation numbers we're looking at right now, the fact that it's been declining since October, it's lagging because, and a big part of that, we've talked about all these rental properties, because rent leases are renewed every 12 months.
Right.
So a lot of the housing expenses are done annually.
Mm-hmm.
So the numbers are naturally going to lag because of that. So, I mean, where do you think that means going forward in terms of the Fed? Because they're still talking about raising rates and everything like that.
Well, they're going to raise rates,
right?
And they aren't raising interest rates; they're raising the Fed fund rate.
Correct. I mean, yeah, because you have speculation. Everyone knows that rates are coming down sooner than later, so
and they're going to continue to fall.
They're dropping just because everyone's expectations on where it's going. But why do you think the Fed is still raising rates on their side?
Because they're dumb.
Even though it peaked in October, and even though we know for a fact that a lot of these numbers are lagging.
I have another TikTok. It's a 3-minute hit piece.
Yep.
On Esther George. I think she's the Kansas City Fed president. And then I also mentioned the Minneapolis Fed president.
Yes.
In there. I think that they are dumb. I think that they don't know what they're doing, or they're trying to hurt the working class people on purpose. I don't think that they understand the lag effect. So I say May 10th that you'll really see the inflation numbers start to come down. Like, they've already come down, which is impressive because of the lagging rents. And a lot of, for whatever reason, leases, a lot of them are signed between October and like February.
Yeah. Which is strange. You think summertime.
February, March. Yeah. But anyways, long story short, the inflation. So if you look at the numbers, inflation is actually down, and it's trending down, and it's going down, which is helping interest rates go down. But shelter costs are actually up, and it's because, like you said, those 12-month leases being signed and things of that nature, right? Yeah. I think by the time that we get these new lease agreements in, you'll start to see that shelter costs come down over the next 3 to 4 months. And by May 10th, you'll really see that May 10th inflation report. That's when you'll see the number really drop. Now, regarding the Fed raising the rate, they're going to overdo it and cook the economy, meaning they're going to put us into a recession. They're saying, what, a quarter point, so another 50 bips.
Right.
I think they need to stop.
I agree.
I mean, I don't understand what they're looking at. Here's the thing, though, and they might be just a little bit smart. What's the rest of the world doing, right? I don't think the rest of the world was raising their rates, their equivalent to the Fed fund rate. I think when England did it, it helped us.
It did.
But a lot of the rest of the world isn't. So maybe they're seeing that the rest of the world isn't. So they're hitting us here. So us as a working class is getting hit harder than other places as a working class.
And I don't think people realize how much that helped us with England doing it too, because like it was about to shock the economy almost.
Right.
Because that was one of the first times they raised it up by 3/4.
Right.
And the economy wasn't ready for that. And if England hadn't followed suit, I mean, we might be talking a lot of different things right now.
Well, you have to think that we're on the same page with England.
Yeah.
I'm sure there were some conversations that were had, but they didn't. We have a way of publicly disclosing things before it happens to get everybody ready so that they aren't shocked. I don't think England did that. But to answer your question, the Fed doesn't know what they're doing if they continue to raise the rate.
Right.
So they want it up to 5.4%. They want it to peak at, is what I saw. So,
which is wild. We're just below 5 right now.
Yeah, we're below 5. So they want another
half a point.
So, and that was the Minneapolis and then the Kansas City chair, Federal Reserve President, Miss George said over 5%. Here's the deal, man. She's worked in that office for 40 years. She's 65 years old. That's the fourth stage of retirement, and she's the Federal Reserve President. I just think that that's wild that these people work for the Fed for 40-plus years in that type of role. It just doesn't make sense to me.
And the Minneapolis chair, like you mentioned, I mean, he's the one that wants to run the economy like you run Uber.
Oh, yeah, that guy's a nut job. How these people are considered experts is beyond me. I think they just go and they work at the same location for 40 years, and then they become an expert. Right. They don't actually have to go out and do anything.
Yeah. But you think that this may even be intentional because the jobless, and I think we talked about this last week, but I don't know how much of that's getting out, about the jobless claim that dropped down to 205,000. And I know you have a lot of thoughts on that in terms of like the different sectors and where that.
Yeah, you have to pull the numbers apart, man. So they're saying that the jobless claims have fallen, but guess what happened? Guess what else fell? Do you know?
What?
The number of hours worked. So more people are working, but less hours. What's that say to you?
Because people are trying to find any job out there because
they lost their jobs.
Job that they actually need.
Exactly. So service industry, rrestaurants, and things like that nature, they're gaining more people, but they're part-time employment, so people are making less money, so less money is going to be spent. We're in a recession. They just haven't told us yet.
Yeah.
You know what I'm saying? Like, we are in a recession that they have not told us, and people are like, oh, well, you're optimistic. Yeah, because I have to be, right? I'm optimistic because looking at the numbers and understanding the economy and understanding the market that I work in and live in and so on and so forth, I should be optimistic because that's what everything says to be. We know when we should be coming out of this. We know when this is going to be turning around. But as far as, jobless claims are down, freak out, raise rates, that's dumb. Pull the numbers apart. If the amount of hours worked are down, that means less people are making less money. They should be looking at how much money are people making, how much money are people spending.
Yeah.
Right?
Right.
That's how you stop inflation. Stop the spending of money. Also, stop printing money. We talked about it.
Thing.
$1.7 trillion.
Yeah.
$1.7 trillion. I'm just like, you got to be kidding me. There's just something about people who work for institutions like the Federal Reserve. I'm not saying that they aren't smart people, but a lot of your third-party people who don't work for a big Federal Reserve like that, it's like they're more knowledgeable about what's actually happening.
Exactly. They are almost out. It's almost like politicians. Like they're out of touch with the everyday person.
Right. Because they're in bubbles.
Once they get to a certain level. Exactly.
We talk to people. Think about this.
Because we're talking about the employment rates because that's part of the reason that the Fed keeps raising the rates up, and we think it may be intentional that they're trying to do this, is to cause more unemployment, to push that number to a point where we hit a recession, because that is going to help inflation as well.
But we're in a recession.
Correct.
But they won't admit it.
With inflation decreasing.
Right.
And they want to do this to a point where it's going to cost people jobs because they think that's going to help
people jobs.
Exactly. But they think it's going to help inflation even more reduce.
So do you think
by costing more jobs?
So do you think that they're lazy? That's the question. This is what it comes down. Are they just so lazy they don't pull apart the CPI report?
Or they're so out of touch that they don't realize
or the jobs
this is
number,
people's livelihoods.
Or manufacturing. Manufacturing is definitely in a recession. Look at the manufacturing numbers. Like, that's a recession.
Look at the mortgage industry.
The mortgage industry is down too, but the mortgage industry is like down because of refinances, right? So purchases are still decently strong.
It is.
I mean, but I'm also in a bubble there too because I do purchases every day and we have a lot of business.
Right.
Right. So
if you were smart, you had your business structured purchase heavy.
Right. And then, but yeah. But, I mean, you also have to staff up for refis.
You do.
So it's one of those things. But what I'm getting at is they're going to drive us into a deep recession. It's sad that they're going to do it. I wish they wouldn't do it, but they're going to do it because they aren't going to take their foot off the gas. And they mentioned that they want to keep being aggressive, and they want to keep pushing, and they want to keep pushing, and they want to keep raising rates. To what point, though?
So, and I want to say this, though, as to not be negative. But and when we say recession, though, we're talking about a slowing of the economy. We're not talking about 2008. 2008 was a depression. This is not like that at all. So,
it was a depression, yeah.
So, things are going to slow down, but it's not necessarily the end of the world. It's not as bad as what everyone's probably thinking.
Well, if it was so bad, do you think that J.P. Morgan Chase, Lennar, BlackRock would be buying all of these homes up?
They would not be.
They would not.
Do you think the construction industry would be putting more job offers out there, hiring more people right now?
No, we're almost out of it. The light's at the end of the tunnel.
Exactly, because they are gearing up for the next 12 months when we're through this and when things are going in a more positive direction.
Well, the other piece of this is then you start to wonder, is this a coordinated effort? Because look at how much wealth transfer there was. Like look at how much wealth transfer there was with savings decreasing for people. It's almost been cut in half since this all started. Look at the wealth transfer with the massive printing of money. Look at the wealth transfer with these big time billion-dollar corporations buying up these houses, and now the wealth transfer is going to be from purchasing your home, gaining appreciation, and paying down the principal to now you're paying these major corporations. Is this a coordinated effort and attack? I don't think so. That's a big time conspiracy theory. A lot of people are like, "Oh, this is the new world order." Da da da. And like, listen, I see all that stuff. A lot of people who pay attention to what's going on see that stuff. But I don't think so. I don't think that they're that organized. Yeah. I think that there's a lot of FUD being pushed. So you have your politicians that elections are coming up, whatever's happening, you have the Fed. They don't want the inflation. They don't want, oh my God, inflation is so bad. They don't want that in the headlines. So what they're doing is pushing, oh, we could be going into a recession. We could be doing this. We could be doing that, because they're trying to scare you. They're using fear to stop you from spending. And then you have the corporations who have some very smart people working for them that they pay a lot of money to help continue to build their portfolios, saying, this isn't that bad. Here's why inflation's up. Here's if we pull the numbers apart, here's what's going to happen. You should buy more homes because that's going to be a great investment and you're going to make money long term.
Right.
And so I think it's like two separate things, that a lot of the politicians and the people who are putting this FUD into the market, it's causing a equal reaction, and it's scaring everyday people. But the corporations have people who are smart enough and do this every day, who dig into the numbers like you and I do, understand we're almost out of this. Right. So they are buying up homes and single family rent and targeting millennials and so on and so forth, because they know that there's an inventory issue, supply and demand, and we're almost out of this, and we're going to start seeing more appreciation. And we're still projected to see a 3% appreciation, right? So that's what, on a $300,000 home, that's $12K.
And probably, at least in certain areas, like
the
Charlotte, the Carolina area.
Right. Don't tell them I don't want them down here.
Yeah. But anyways, and kind of going off of that too. Like, I mean, we have a friend that's in commercial construction.
Right.
I was talking to him a few weeks ago, and he was telling me, like, the last 4 or 5 months, it's been the busiest time that they've had in years.
Right.
Why is that? Because businesses know that they are expanding now. They are putting their resources into work now.
Yeah. When everybody else is running, press the gas pedal.
Yeah.
Right?
Exactly.
That's how you get big. That's how you continue to grow your business. The big corporations, some of them don't do that.
Yep.
They'll cut jobs or repurpose jobs or do whatever.
Yeah.
But yeah, I press the gas. You know what now would be, with all this talking about the market.
Yeah.
You know what now would be a good time for?
What is that?
To bang that red subscribe button and turn on the notifications. Don't forget to leave a comment. If you leave a comment and then after the comment, your Instagram handle, you have a chance to win a $100 Amazon gift card. You know what that will help with? Those 18,000 employees that Amazon just laid off because the Fed keeps hiking the Fed's fund rate, hurting everyday Americans. Right. So, folks, do us a favor and bang the red subscribe button. And if you don't already, go to Twitter, Instagram, Facebook, LinkedIn, and anything else, TikTok. We are NBI Financial Group on all of them, and we are constantly releasing content. Please give us a follow, and thank you for watching. On to the Next, Ben.
Let's get it. There's some news out there the other day. I think we'd mentioned it at one point. But Wells Fargo exiting the correspondent
They did.
market.
Oh, and I have a great
did.
video. It isn't out yet, but I recorded the video this week. It's a great video on Wells Fargo exiting correspondent lending, and their CEO of consumer mortgage sales or consumer mortgage said the reason they were doing it was because they were trying to limit their reputational risk by partnering with correspondent lenders, which are typically smaller lenders in communities. Wells Fargo backs it. Their correspondent, a lot of times they'll underwrite their own stuff. Wells Fargo takes it, backs it stuff, so on and so forth. If you don't remember, Wells Fargo got into a little bit of trouble not too long ago.
Oh, they did.
With mortgages, and they lost a lawsuit for what, $9 billion or something? With a B? Not billion. Billion.
If you didn't apply for an account or a mortgage, they might have given you one anyways.
Right. So Wells Fargo, and his name is Cleo something, Hispanic guy.
Right.
And the reason I bring that up is because I think it's absolutely ruthless what Wells Fargo is doing, right?
Yeah.
So 10% of Wells Fargo business is GSEs, which is FHA, Ginnie Mae, right? Government-sponsored enterprises.
Right.
So that's government loans. 10% of the market was from that correspondent, right? So what's this do to the market? So Wells Fargo gets out of correspondent because of reputational risk. But the next sentence out of the CEO's mouth was, we will continue to be the number one lender when it comes to the minority community. Okay, cool. Like, what's that have to do with anything, right?
Right.
So then they go on and talk about reputational risk, and they forget to mention that they're down 27% year over year in correspondent business. They forget to mention that, right? But the article did a good job of bringing up how much they were down. The CEO forgot to mention that.
Of course.
AKA they're not making money. But guess what? They're going to take another $100 million, and they're going to put it towards their community programs for Black and Hispanic communities. And then they go to remind us again, just one more time. Guess what they are? They're the biggest lender when it comes to the Black and Hispanic communities. And so now I'm sitting here, I'm like, I see what you're doing, but everyone else does it. You know what they're doing, Ben?
Tell me.
So let's take a little trip down the road in the mind of Nick, right? So in the mind of Nick, I'm like, that's weird. They're talking about leaving correspondent lending. Why do they keep mentioning the minority community? So let me preference what I'm about to say with, I think it's great that there's equal housing and that there's programs to help bridge the homeownership gap for Hispanic and Black people, minority communities in this country. I think that is freaking awesome. What I don't like is when a company like Wells Fargo tries to use the current temperature, the current climate in this country, and use that to say, hey, we're shutting down correspondent lending, but hey, that's what we're doing. But look, we're the biggest lender for the minority community. I don't like that. So
let's be honest.
Let me tell you why.
Yeah.
I don't know if you've gotten down this road yet. So when it comes to affordable housing and housing programs and people being able to afford houses, FHA is a really popular program,
Absolutely.
right? So Wells Fargo has 10% of their correspondent business. They have 10% of the market, 10% of the entire market, which is a huge percentage in the mortgage industry, is government-sponsored enterprises, which is Ginnie Mae, which is FHA, right?
Right.
So if you're helping people who need help getting into homes, FHA is probably the way you're going, right?
Yeah.
So Wells Fargo exited correspondent lending, 10%, which is a lot more than $100 million. 10% of the market's a lot more than $100 million, wouldn't you think?
Yes.
Okay. So 10% of that business that you were taking as a correspondent lender or working with correspondent lenders was FHA. That now goes back into the market, and you have places like NewRez and other big-time companies who offer MSRs and who do correspondent are going to gobble up that market share, right?
Right.
So you just took 10% of the entire market and spread it out amongst 3, maybe 4 big-time lenders. Who's that hurt? The consumer! If there's less competition in the market, guess what? Rates are going to go up, costs are going to go up, so on and so forth, right? So 10% of the market is now getting spread out. There's less competition. So why do you think that the CEO of consumer lending for Wells Fargo keeps mentioning the minority community and what they do for the minority community and what they're going to do as far as direct lending for the minority community? Because them getting on a correspondent directly impacts and directly hurts minority communities, because minority communities who need down payment assistance, those are FHA programs.
Right.
There's less competition. It's going to drive the price up. Period. That hurts the minority community. That hurts every first-time home buyer.
It does.
That hurts non-minority community. That hurts everybody. Why are they doing it? It has nothing to do with reputational risk.
It's bottom line.
Bottom line. Bottom line. But hey, they're still the biggest lender to the minority community, but now they're probably ripping them off because that minority person is walking into the Wells Fargo that maybe they even bank at and getting a higher interest rate and 4% origination charge, hit with higher closing costs. So what I'm getting at is those programs that Wells Fargo is replacing their correspondent business with, that $100 million, it's not even close to 10% of the market share, one. And number two, if you really want to work with somebody who cares, whether you're a minority person or you're not, first-time home buyer or you're not, if you want to work with somebody who's going to tell you the truth, work with a mortgage broker, period.
A broker won't make you take 60 to 90 days to close either.
No, that's a Wells Fargo thing. They're good at that. They'll probably open up a fake account in your name as well.
Probably so.
And then get sued for $9 billion. But yeah, my thoughts on it, and I have some TikTok videos and stuff I did with the article. It's just absolutely ridiculous. And I hate how people try to use the current state and the current climate in this country, which there's a lot of talk about equal opportunities, equity, that type of thing. They're a big corporation. They don't mean it. They're cutting a program that could actually help people gain equity and appreciation in homes, help people who are possibly first-time home buyers. They're taking that and then they're just getting rid of it, which is hurting them. And then they want to say, but we're the biggest lender for minorities. I just think it's a bullshit cover-up, and it's actually hurting people. And the person who is the CEO of consumer lending should be ashamed of himself. He happens to be Hispanic, and he's literally doing this, and it's hurting this Hispanic and Black and first-time home buyer, white, every community.
Banks don't even look at it as helping a client get a home. They look at it as a added service, as a cost to them.
Right.
They don't want to do mortgages.
Right. They don't.
Like
they do. They do the mortgage so they gain your accounts.
So they get your banking account.
Right.
That is why they do it. Because that is what they're focused on. That is what they care. Like, that's the business.
Because they make their money by taking your money that's in your bank account and lending it out. It's why when I go to make a X amount of dollar purchase, that's why they cap business bank accounts on how much you can spend on your debit cards. That's why when you go into a bank, and if I wanted to go into a bank and take $100,000 out that was in my account, most of the time the bank's not going to have my money.
Well, because
I'm going to have to go to 3 different banks.
Right.
And then you have to. My favorite was. So I sold a house, and then I was buying another house, and I was buying that house, and I had to get some cash out, and it was around $100,000, right? And I was just moving it to a different bank account. But I did an experiment. I was like, I want to go in to this bank and see if I can get $100,000 cash out. I've never seen $100,000 cash before. I was broke as hell till this happened, and then I was broke right after I blew all that money, right? So, so I went into the bank and I asked for my $100,000. You want to know what they said?
What?
We don't have it here. You have to go to the main branch. Where's that? 30 minutes away, downtown. Okay. So I go to the main branch. I want to take $100,000 out. I have more than that in my bank account. I want my $100,000. I had to write on a slip of paper why I was removing that money. So I have to tell you why I'm removing my own money?
I mean, was it for like anti-money laundering or?
To remove $100,000?
I don't know.
I have no idea. Bank of America's done that to me before as well. I'm not a fan of Wells Fargo. That was a Wells Fargo.
Yeah.
I'm not a fan of Wells Fargo.
Oh, I know.
Wells Fargo screwed up my accounts so bad. Cost me probably thousands of dollars because of they made a mistake, and I never got reimbursed for that. It was with our business account too back in the day, and our business accounts are now with a different bank that has been very good to us, and I won't bank with Wells Fargo ever. But yeah, man, I think that was a pretty good episode, other than all the back and forth with our disagreements. But I think it's good that we disagree on some stuff. You're going to be wrong, but it's fine.
We'll find out.
Yeah, we will. So, you got anything else for us, Benny? Big Boss Ben?
Nope. That's a wrap.
That's a wrap. Well, folks, that's all we got for you. Yep. Thank you for watching. And one more time, if you haven't done it already, bang that red subscribe button, turn on your notifications, comment on this video. Did you like it? Didn't? What were your thoughts? Make a comment, put it in the comments, and leave your Instagram handle. And on January 31st, you have a chance to do what? Win $100 Amazon gift card, even though they laid off 18,000 employees because the Fed keeps raising the Fed's fund rate. But that's neither here nor there. Thank you for watching. Follow us on all our social media, NBI Financial Group on all of them. We're out. Peace!